Right, good morning, ladies and gentlemen. What a privilege to be back with you all again for Boutiques on Wednesdays in interesting times, to say the least. Towards the end of 2024, with markets doing exceptionally well, we've heard the phrase from managers saying that equity markets, especially the US, were not pricing in much room for error. That said, we heard many convincing arguments why earnings growth can and will continue. Then we got the Trump disruptor. One of my colleagues sent me a very interesting picture last night of a very orange swan and Trump's head stuck on the swan with the title, The Orange Swan Event. Maybe someone smart will write a book on this one day. The one thing we've learned is not to sell in times of fears and supposed to look for opportunities. But our market's not in a free fall. More talk again about the US recession. And 2 weeks ago, people said the Fed is probably not going to cut rates, or maybe one cut for 2025. And with tweets and comments coming out over the past week saying maybe the Fed should cut as much as 5 times this year. Who knows? Trade wars are almost doing full circle, where it seems like what we initially thought will be a fight between China and US are actually doing full circle and coming to exactly that. Except, of course, for places like Lesotho, they're really getting nailed. On the local front, we have our fun politicians, and appropriate that Parliament is held in a tent because it does feel a bit like a circus. But I think what we all want to know is, will we get a result that is supportive of economic growth in South Africa, which we desperately need? It feels a bit like pre-elections, where the outcome can either be super good or perhaps an atomic bomb of self-destruction. All this has major impacts on global asset classes, as we know, and especially that of SA fixed income as well, and we will cover some of that this morning. And clients are asking, should we default into capital preservation mode, or are we brave enough to see some remaining opportunities out there? Joining us this morning with so many challenging questions, and I'm sure from the audience this morning as well, is Warren Riley, analyst and co-portfolio manager at Bateleur Capital, and Rafi Ridgestein, portfolio manager at Sasfin Asset Managers. Rafi will focus on fixed income, and Warren will focus on equity. Good morning, gentlemen. How are you this morning?
Morning, Eugene. Thanks so much for hosting us.
Morning, Eugene. Great to be here.
Fantastic. And again, thank you for your time this morning. We really appreciate it. I'm sure you are massively busy at the office trying to figure out which way to go. And that's exactly why we're here, so that you can share your views as to where we should go. And with Sasfin and Bateleur. Rafi, I believe you are first. If you want to, you can start sharing your slides. And while you're doing that, to our audience, you know how it works by now, the Q&A bubble. As we progress, you're more than welcome to post questions, and we'll try to cover as many of those as we can. Rafi, your presentation's up and running, and we are ready for you if you are, sir.
Okay, wonderful. Thanks so much, Eugene. It's always a pleasure to be with you. And as you mentioned, quite the time to be presenting and sharing some thoughts. I'm not sure if any of us really can honestly say we know what's happening, where we are, and what's gonna be, but maybe a little bit just to touch on briefly 3 macro themes in terms of where we're holding. Try and look at the current environment, both from the GNU as well as the tariffs that have been leveled against everyone by President Trump. Have a look at what some of those unintended consequences may be for the global economy, and then briefly touch on how we approach fixed income and what we're looking at in our funds. So, I mean, the truth is, even before last week, with the budget impasse and the struggles that we saw with our GNU, and even before President Trump had implemented these tariffs, we really were in a situation where there was a growing uncertainty, a very difficult environment where really everyone was beginning to be concerned, a loss of confidence, which we'll speak to a little bit later. And as we've seen some commentary that's come out recently on the back of these tariffs, you know, I've seen analysts talk about the egregious, terrible, damaging policy error that the tariffs were implemented in a way that was stupid and arbitrary. And some are questioning if maybe this will be a repeat of the Smoot-Hawley tariff, which is considered still one of the most catastrophic acts in congressional history. And I guess that's something that we'd have to wait and see. And of course, locally, to compound everything in our perfect storm, you know, the challenges and the difficulties that we're seeing within the GNU, we thought maybe that some of the infighting and the succession battles within the ANC might just wait until next year's municipal elections. But this budget and the struggles around that seem to have opened up the door once again, for some of that infighting that's compromising our stability at the moment. I think this thinking, and a couple of months ago when I was in Cape Town and chatting to Becca, who's head of our institutional business, he introduced me to Ray Dalio and his thinking around the changing of the world order. And on the back of that, I guess, his question has been, and really maybe looking at this chart where you see in 2000, where the US was the largest trading partner within the world and certainly the most powerful. And we've suddenly seen a shift where China seems to be overtaking them in that regard. And he's posed the question in a recent note, are we seeing a classical breakdown of the major monetary, political, and geopolitical orders? And is this a final attempt of the US to retain its status as the leader of the free world? And what could be the consequences then of the tariff? And maybe the tariffs really aren't about the tariffs, but really about trying to protect the US's stronghold and status as the world leader. I mentioned this briefly before, but this chart really, I think, speaks so much to what's going on, which is a total collapse of sentiment, both within US consumers and business, almost globally, in fact. And, you know, just to even highlight, Jamie Dimon, who's the head of JP Morgan, mentioned in his new letter, which was recently published, how damaging and challenging and what the potential impact of these tariffs could be on global trade, on sentiment, on confidence. JP Morgan increased their recession risk for the coming year to 60%, which is in line with several houses that now look at that stagflation, inflation, recession as major concerns that we'll have to grapple with during the course of this year. And Jamie Dimon, for example, in his newsletter made the comment that the quicker we're able to resolve this issue of tariffs and how we approach them, the better, because some of the negative effects increase cumulatively over time and would be very, very difficult to reverse. And I think the loss of confidence, just to speak to one point of it, is that normally in times of crisis, we always see the dollar as being the safe haven asset that everyone flees to, even when the US is the one responsible for the crisis. And in this time round, if you look at the US dollar index, which was at about 104, if I'm not mistaken, which is just as an average of how the US dollar trades, it was at approximately 104 when the tariffs were implemented. It's now down to about 102. So that sell-off in the dollar and the loss of confidence in the dollar as that safe haven currency and the safe haven asset for global assets is something that we'll have to keep a very close eye on and assess as things go along. Has the US, even let's say today Trump cancels and reverses those tariffs, has the US lost the confidence of the global economy as a partner for strategic growth going forward? And that's something that we'll have to keep an eye on. Locally, just in terms of what that impact would potentially be of those tariffs, this is work that was done by Standard Bank. This was on the assumption that there would be across the board a 10% tariff implemented on everyone with retaliatory measures. In the end, I think South Africa, we got about 30%, and that overrides AGOA as well, which is concerning for for those industries affected. But the basic thinking is that in the short term, the impact on US and world, both growth and inflation, is quite significant. 0.5% increase in CPI for the US. You can see the impact on GDP and growth. And that then really speaks to the concerns and the risks around a triggering of a global recession and potentially a stagflationary environment. And just locally, when you look at the numbers, it is somewhat more muted, But I think we could, and especially because of the difficulties that we're also experiencing in the GNU, Standard Bank came out with numbers that instead of maybe reaching that 2% growth that everyone was hoping for and talking about, maybe more likely we'll end up looking at about 1.3%, 1.5%, or thereabout between this year and next year. And the impact on inflation may be slightly more muted, but what that would though speak to potentially as maybe a silver lining is the opportunity for the SARB to cut further and deeper than they were originally planning for. And that probably, as Eugene, you mentioned in your introduction, opens the way potentially for the Fed as well. Just in terms of what to look out for and what we've seen, this was only done, I think, until yesterday. And what this chart, just to try and explain it briefly, says that if we'll go back 9 days before the onset of some or other crisis, how did our bonds react in that environment? So if you look at the bottom, it starts at -9, which means 9 days before the event, and then following on through time. The darker blue line, which spikes all the way up, is what the impact of the bond market was and the reaction of the bond market in the wake of Nenegate after the finance minister was fired back in December 2015. And as you can see, bond yields spiked almost 2% immediately as a result of that announcement. After in 2022 with Lady R and the load shedding crisis, initially bonds only spiked about 0.7 or thereabout, and later things did get worse. But if you see the pinkish line, this reddish line over here, what that then really speaks to and says is that in the meantime, at the very least, either because quite a lot of risk had already been priced into our curve going into the tariff announcement and the collapse of the budget talks, as well as potentially the fact that so a lot of risk had already, been priced into the curve, but we haven't really seen a substantial move yet. Half a percent up in bond yields isn't that significant. And because of that, I would suggest that it's something that we do have to keep an eye on, that should there be further deterioration, whether it be because of tariffs, whether it be because of the political fallout with US and South African relations, or because of the GNU potentially collapsing and all of the noise around that, despite the pressure of business to try and resurrect it and keep it stable, we could, though, see a further sell-off in bonds and something to be very cautious of going forward. Unintended consequences as well, just because of the general regime, just to maybe speak to some of them. China controls export licensing, and I thank Arno, our chief investment officer, and a great mentor and guide and partner in managing our income funds, for highlighting some of the unintended consequences. China controls the export licensing for a lot of rare earth minerals, things like, some of the terms I only found out reading in the articles recently: dysprosium, indium, yttrium. 10 points for anyone who can spell those, especially yttrium and where they are on the periodic table. But they things that don't really make so much of a headline, but are essential components in things like jet engines for your Air Force airplanes, things that go into solar panels, clean energy, electric vehicles. And China controls the supply chain of a lot of those minerals and metals, and they can decide just not to allow people to provide those minerals to the US. And if you can imagine the disruption to supply chains that could be a further consequence of these tariffs and the fighting between the US and China, could severely compromise potentially even the security of the US and their ability to make sure that their defense spending and the maintenance of their army and their fleets is up to scratch. Another article that came out over the weekend from Bloomberg is that 43 billion of bonds and loans is now currently in distress as a result of the new tariffs that are implemented. Maybe just to touch briefly on our funds and what we're doing. We have 2 income flagship funds: our Sasfin BCI Flexible Income Fund, which is our bond, which is in the multi-asset income space. It's a bond-like fund where we try and target bond-like returns with less volatility. There we're able to use all of the levers available, whether it's yield, curve, credit, duration. And then our Sasfin BCI High Yield Fund, which is basically an enhanced cash low volatility fund, paying out monthly income and primarily with a floating rate exposure and tracking interest rates. In terms of the composition of the funds, typically, because the flexible income fund is targeting those bond-like returns, we generally have a core component of fixed rate notes, floating rate notes, and cash. Whereas in our high yield fund, it's really primarily floating rate notes and cash and money market instruments. And although this is a chart that goes back to February, currently our allocation and positioning is we've only got about 45% in fixed rate notes in the flexible income fund, and we've increased cash because of the volatility and uncertainty to about 10.5%. And in our high yield funds, probably sitting around 85% in floating rate, and most of the rest of that in cash and money market instruments. Just looking briefly how we approach risk, and to speak to that, you know, we generally look at risk as being something that must be, that we always try and take the appropriate risk at the appropriate time. And just speaking to that, you know, coming out of the elections last year, there was a massive risk premium built into our yield curve, and there was an opportunity to increase duration significantly, and the fund pushed all the way up to 3.8. And then since September, and especially November after the US elections, we've been actively reducing duration within the fund, trying to, number one, because the bonds had rallied so hard, and because we felt that because of some of the disruptions that were coming through in the what's it called, in the GNU, as well as the noise coming out of the US from President Trump, that it would be opportune to reduce risk. And we brought that duration all the way back down to 3.10. Even at the moment, it's below 3 at the moment with all the things going on at the moment. And something that we always try and say that, you know, we can't bet on binary outcomes. We're also responsible to try and preserve capital as much as we can. And by reducing duration and reducing our exposure to the longer end of the curve, we were able to preserve and outperform the all bond index over this period by about double. I think we did about 1.6 till the end of March versus 0.7 to the all bond index, and where the longer end has sold off about 0.7%, at least till the end of March, without taking into account the current environment. You know, we were able to really protect some capital by avoiding the longer end over the period. Just briefly looking at performance of the fund over the longer term, obviously in periods of extreme outperformance of the all bond index, as we saw last year, where over 1 year till the end of February, the all bond index did 17.5%. Our flexible income fund, because we have less duration in the fund, would slightly underperform. But really to highlight on the very right-hand side, since inception performance, where we've managed to achieve almost double-digit returns, cumulatively almost 150% in the fund since inception. And looking at other asset classes, actually has outperformed most other indices, including equities, bonds, cash, and has outperformed and has given you a real return of almost 5% over that period. And our high yield fund, which is really just that enhanced cash fund, through the different cycles over 1 year, 3 year, and since inception as well, has managed to well outperform peers and cash. Just briefly, I'm not really going to touch on this too long, but we do significant and extensive modeling just in terms of trying to understand where we are. This is for the all bond index and what returns might be. Initially, the modeling we had done at the end of December, we thought perhaps we could still get double-digit returns. And maybe now we have to be more concerned that scenario 2, this bear case, is perhaps a more likely scenario. Thank you, Eugene. I'm going to stop over here just to give Warren time as well.
Thank you, Rafi. Warren, you can start sharing if you want. If you're ready. Yeah, I've got your presentation. You can
Thanks, Eugene.
start. Yeah, thanks.
I'll jump right in. We've got quite a few slides to get through here today. Obviously, a lot of topical things to focus on. I'm going to spend the majority of the presentation on our current view on markets and the macro backdrop, and I think in the context of equities. Very briefly, Bateleur Capital, we're in our 20th year now. The business was founded in 2004. We've steadily grown to manage today close to 16 billion in assets. And if you look across our funds, we've all outperformed their respective benchmarks since inception. And we remain a very focused business with all our funds equity-centric and applying the same investment process. Now, to the today's topic, this is a cartoon of Tintin and the Captain. And I think it's a slide that appropriately captures the current global macro environment. There's so much change taking place, and it's making for a very volatile investment backdrop. But I think in this environment, it's very important to be sticking to your investment process and your investment philosophies. I think chasing short-term trends can result in a very dangerous environment for investors. If you go back just 6 months, when Donald Trump came in as the US president, the world was a very different place. There was an overriding view that the only place to invest was the US. There was a term being branded about the US exceptionalism, and this largely came as a result of, if you look on this chart, US GDP growth outperforming the rest of the world, and especially Western peers by a considerable margin. The US grew at a compound 2.4%, the rest of Europe at 70 basis points, and Germany's economy was actually flat. The US had a significant tailwinds in this environment from its expansionary fiscal policy, which was very different to the rest of the world. They spent over $7 trillion on fiscal packages, which supported the economy. You can see the chart on the right-hand side that US fiscal deficits have been running between 6 and 8% since 2019, whereas the rest of the world, and in this chart showing the Eurozone, was running almost fiscal austerity and attempting to reduce their deficits and debt. There are longer-term consequences from what the US fiscal spend will mean for the US debt and its interest bill, and it's actually a keen focus on the current Trump administration to bring that down and reduce the fiscal deficit and the debt. If you look at then this the net result, that higher US GDP growth, US equities outperformed due to higher earnings, and net, you saw 14.5% compound returns from the S&P, whereas Europe, which has long been considered very sleepy and austere, only delivered 5.6% compound. And in the case of China, which went through its own period of heightened regulation and government intervention, delivered minus 3.2% for a very tough time for the rest of the world, whereas the US was essentially the only place to be. I mean, following the US election, it was really consensus that Trump coming in was going to be very positive for capital markets. He had a very pro-business and pro-capital market policies, and his reduction in red tape, taxes, and onshoring was seen to support the growth in the US economy. And achieving this over the medium term was seen to benefit corporate earnings growth and stock market. When you look at investors like Druckenmiller, Stan Druckenmiller has been in the game for almost 50 years, and he's famous for not having any negative years. He was too bullish on the Trump administration, and also citing that at the time, CEOs are somewhere between relieved and giddy with the Trump administration coming in. However, if you look back now and see how things have played out, it's been vastly different. So US policy uncertainty is at a record high, and that's coming through and impacting US small business, which is 60% of the economy. And it's also now translating into a slowdown in GDP growth. So on the right-hand side, the chart shows that the lead indicators for GDP growth has turned negative in the US. And Treasury Secretary Scott Bessent has recently cited that the US economy is going to go through a detox period as they essentially reduce the role of the state or the government in the economy and bring down spending and deficits, as well as now renegotiating on tariffs. So in the short term, there's significant pain being borne by the US economy. Briefly on the tariffs, what we've seen come in is certainly worse than expected. If you look on the left-hand side there, the US good imports and the red bars, and then the new reciprocal tariffs coming in, the EU and China are critical trade partners of the US, and they've been slapped with 20% for EU and China 34%. But as you would have seen this morning, that's now jumped to over 100% with additional tariff Trump's put in, as well as the existing tariff. So a very large dislocation occurring in global trade. And on the chart on the right, if these tariffs stand as they've been implemented by Trump without any negotiations, we're going back to tariffs last seen almost 100 years ago. And as Rafi pointed out, very significant negative drag on economies. Expectations are that the US GDP will shrink by 1.5% and inflation will increase by over 150 basis points if there are no negotiations. Our base case is there will be negotiations around these tariffs, but going forward, there will still be an element that is retained and that will impact global trade. At the same time, the US threat to NATO and its reduction of defense spending in Europe has galvanized Sleepy Europe. And what you've seen is that they're moving from fiscal austerity to introducing a fiscal bazooka. They plan to spend $900 billion on defense and infrastructure over the next 10 years. And a big benefactor in the European markets has been defense stocks. If you look on the right, a basket of defense stocks were up almost 80% year to date. So a very significant change. And I think if you look at the German economy, they can afford to be doing this now. They've got debt to GDP of 64%. The US is at over 120%, and they've been running quite low fiscal deficits for many years in Germany. China, on the other hand, remains a tough economy. There's significant headwinds that still exist around property sector. Consumer confidence remains at lows. And I think what's reasonably positive in China is that the households and the consumers have the ability to consume should sentiment improve. You can see on the right-hand side that household savings rates are sitting as high as 35%, which is much higher than the rest of the developed world. And we're starting to see some positive noise coming from government and very supportive of the private sector. So you see the recent meetings, for instance, with Alibaba. They met with the president, which is almost unheard of amongst other Chinese CEOs. And their comments were that this meeting has given them confidence to put earnings back into capex and investments and reinvest in the economy. And a big focus on boosting consumption from the Chinese government, which, if we start to see sentiment improving, should result in some of that pent-up savings being deployed into consumption, which should benefit that economy. Now, if you go back and look what expectations were, what's played out this year, it was base case or consensus that US would remain exceptional. Trump would lead to deregulation, taxes coming down and improved growth. Europe was in a slumber, increased regulation, austerity, and slow economic growth would just continue. And that China, and it was in a crisis and largely uninvestable, was slowing growth and limited private sector support. What has played out is obviously vastly different. We're seeing US growth now slowing, hostile foreign policy, tariffs, and heightened uncertainty for business. Europe's awakening because of the moves that Trump has put against NATO and as well as the tariffs against the economy. And this is galvanizing Europe to invest, and which should lead to faster growth in time. And in China, which is coming from being uninvestable, governments moving to be more pro-private sector, they're even showing leadership in certain technologies such as AI and automotive, and there's stimulus coming into consumption of what is a very low base. And that's reflected in the index performances year to date. So although we've had a very weak start to April, you can still see that US, as the S&P 500 is down almost 14% year to date. Europe's down 1.5%, and China's still slightly positive. And really a reflection of the changing world order that we've seen. I think importantly is always, it's in this kind of backdrop to come down to valuations. And when you look in the chart on the left-hand side, the S&P's had a significant extended run of outperformance of the rest of the world. You can see that I've circled there. The recent underperformance is really a blip on that chart. And as it stands today, the MSCI World has 73% of its constituents in the US, so very over-indexed to the US economy. And on the chart on the right, the S&P 500 still trades at an 18.3 forward PE on what is quite heightened earnings expectations. The market expects US earnings to grow 9% this year and 14% the following year. if there's a recession in the US, those numbers are not going to be achieved. And that P rate, that 18.3 will turn out to be higher. So we think there is still risk in the US markets, whereas you look at the Europe and the rest of the world trading much more in line with long-term averages with relatively lower earnings expectations. And again, turning to China, Chinese markets have underperformed the US significantly over the last few years. And when we look at the earnings expectations and the valuations, trade at a much lower valuation with similar type of earnings growth. So we see better margin of safety in US tech right now relative to some of the US. I promise we are going to speak on South Africa. And I think the key for us on South Africa is we need faster economic growth. And if you look at the recent data that's coming out, it is a bit concerning, especially the ANC Secretary General, as shown on the left-hand side, celebrating positive 60 basis points growth for the US, for the South African economy in the fourth quarter, which is not enough to bring us out of our low growth trap and increase GDP per capita. What we've seen in the short term is business confidence improving, but very limited translation of that into actual earnings growth or fundamentals of the underlying businesses. So we are questioning whether South African GDP can accelerate this year to the 1.7 and 1.9% that's expected by the market. At this point in time, that's looking like quite a low probability. When you go back and look at the reform, and this is being largely conducted by government through Operation Vulindlela, we've met with the mining companies, and I'll use an example here as on the iron ore line. We've seen stability on it. So you can see on the left, export volumes are largely in line with last year. And we've seen, though, from the miners on their guidance for the next 3 years, there's going to be no pickup in volumes. The reason being that in order to fix the iron ore line, you need to invest considerable time and money, and this will take up to 3 years to fix. So there's no quick fixes to the structural issues facing South Africa. Recent corporate comments have also been very mixed. I've got quite a few there, but I'm not going to go through them. But really, this is to say that majority of companies we've interacted with that's recently reported have pointed to a continued tough environment. And the very lofty expectations that were built into the market last year are not coming through in what corporates are seeing on the ground. And you can see that here. If you look on the left-hand chart, the SA Inc. weighted basket, this is a basket of South African-facing companies. There was a large rally last year on expectations of accelerating economic growth, and that's now been all given up and more. So they've all derated. And you can see on the right-hand side, net foreign equity flows in South Africa. There was actually a nice turn post the GNU with foreigners finally coming back into our market. They've now turned quite large net sellers. And we've seen quite a large outflow out of SA-facing companies the last few months. I think encouragingly, though, when you look at that setup with a large derating in the companies, there's obviously now better opportunities to be found once again in South Africa. Turning to interest rates, South Africa has, we think, a policy error that's being conducted by the South African Reserve Bank. Real rates are at record highs. You can see the dislocation between, on the right-hand side, inflation and where the repo rate is. We think the SARB has significant room to cut rates here, but they're not willing to do so until they see economic growth. So it's a bit of a chicken and an egg. Again, I agree with Rafi, as he pointed out, that we should see further rate cuts, given that the US now is expected to cut over 4 times this year. With this big derating in South Africa, you can see our valuations are now back to being attractive after quite a large re-rating last year. And our government bonds, another indicator of the valuation of our assets, are still offering attractive real yields. So we're still finding plenty of opportunities in the South African space, but obviously quite selective and cognizant that in order to see a further re-rating in our companies, we'll need to see this economic growth come through. I want to talk quickly about 2 opportunities in the SA equity space. I think when we look at the portfolios, we are being very selective. We've moved our funds to be more defensive. We've reduced cyclicality given the slow, the outlook for growth, largely increased our rand hedge exposure. African Rainbow Minerals is an interesting one. So a diversified miner, it's got an almost 12% stake in Harmony Gold. So Harmony Gold has obviously done very well the last few years and has delivered since the beginning of 2023 almost 350% total return. African Rainbow Minerals has actually declined 35% over that time. So you're at a point today where the stake in Harmony Gold now is worth 20 billion rand. It's 60% of African Rainbow's market cap and almost 87% of its enterprise value. The key chart on the right shows that the implied value of African Rainbow's core assets, which are profitable iron ore, manganese, and PGM mines, is only valued by the market at 3.8 billion rand today, which is about a 1x PE. This doesn't mean anything if African Rainbow Minerals management is not willing to do anything about the discount. We are engaging with management on options to unlock value, and we do see a couple of paths ahead which can unlock significant shareholder value. On Reinet, it's a new addition we've been adding to our funds. Reinet has completely exited the stake in British American Tobacco towards the latter parts of 2024 and into early 2025. They've raised significant cash, so they now have almost 2 billion euros in net cash on their balance sheet, which is 46% of their market cap. If you look at the discount to NAV, it's now trading at 38% and actually has widened further the last few days to over 45%. And within that NAV, you've got a large portion of cash, a large stake in Pension Corp, which we think is a fantastic business. And we believe that the discount should reduce. And there's also opportunity for corporate action here, either management buying back shares or delisting Reinet in time. Finally, just turning to the fund. The fund's medium-term track record has been sound with 3 good years of outperformance. And then 2024, we saw was a more average year for the fund. I think it's important to remember that this fund is built bottom up and looks very different to the index. And there will be certain times when our returns do lag the index during certain market environments. Since its inception in 2012, the Bateleur SA equity strategy has delivered returns of almost 12% against the benchmark's 10.3%. Thank you. I think I've gone a little bit over time here, but that is the end of the presentation. We're happy to now take questions.
Warren and Rafi, thank you very much for that. Warren, while I've got you on the line, maybe I can start with you. I don't see any questions from the audience yet. More than welcome to post questions as we go along. Warren, just quickly, you mentioned that you've increased your Rand hedge exposure in the portfolio. Rafi might mention, that, and we've seen it in the currency value, that the world almost lost confidence in the dollar, that flight to safety is not happening anymore. The dollar under pressure, and maybe that's something by design of Trump. Trump wants a weaker dollar because it supports US exports, but let's see where it goes. But how does that pan out then for Rand hedge stocks if we think that the dollar is going to remain under pressure?
Yeah, I think the Rand hedge stocks is a different scenario. So the Rand has been a significant underperformer year to date versus emerging market currencies, probably one of the worst. If you look at the Mexican peso and the Brazilian real, they've actually been quite a bit stronger. The Rand's weak because of South Africa's own goals around the GNU, increasing risk premium. And so what we've seen, if you look at the Rand dollar, it's been relatively weak, but the pound and euro have been actually significantly weak. We're hitting new lows today. So the Rand hedges we've been acquiring are relatively defensive shares. Bidcorp's one name that comes up, a big benefactor of a weaker euro and pound, and relatively defensive earnings profile. And then I did point to Reinet, which is a British asset largely with euro cash on the balance sheet. So I think that Rand hedge view needs to be seen in the context of South Africa risk and how we're trying to, in a SA equity portfolio, reduce the exposure to what is quite a volatile environment.
Warren, you mainly spoke to your SA equity fund, but you've got a flexible fund as well where there is allowance for foreign exposure. The equity fund, as we know, is only a SA equity fund. But I just want to get to your foreign exposure just to get a sense of what you're looking at there, because you spoke to the US, you spoke to Europe, and I almost get the sense that Europe and I think UK as well, it's probably got more leg room for fiscal stimulus. They can definitely, I think, cut a lot more aggressively than the US. All depends on where the Fed's going to go from this point on forward. But in your global carve-out, in your flexible fund, is there a shift more towards Europe? And in the same breath, would you ever look at emerging markets?
Yeah, no, I think the beauty of the flexible mandate is the ability to de-risk when we see trouble in the markets and we have some concerns. I mean, there we've increased our cash holdings quite considerably. We've reduced our foreign equity exposure from probably over 30% last year to now down to 20%. I think it's probably one of the lowest levels of foreign exposure we've had in quite a long time. And that's for overall risk, because we do think if the US market goes into recession, the rest of the world's not going to get by without a recession themselves. But where we do have exposure, we have increased in exposure into Europe, and a good diversified portfolio with defensive holdings, staples, and over the period also reducing our US tech exposure in favor of some exposure in China. So quite a balanced view, but net we've reduced risk in the portfolio quite considerably over the last few months.
But I mean, SA equity, back on SA equity, showed the valuations, most certainly very, very attractive valuations. Again, SA Inc. gave up most of the gains that we've had. But in your flexible funds, especially on the SA equity component, are you buying back in? Is this a time to say, but, you know, take this opportunity? Things are cheap. And some of the SA companies, I mean, remain resilient. Yes, there's concerns about where growth is going to come from. But is this a time to up your SA exposure ever so slightly?
Yeah, we've been very selective in the sell-off. So coming in on Monday, the markets obviously were very weak. I'm talking about this week, Monday. We had a drawdown of almost 15% from top to bottom over really a week.
Yeah.
There were select opportunities, and it's been really in quality names that have derated significantly, where we still have good visibility on earnings. We're not buying cyclicals here. Again, quite a defensive lens, and companies that we know well. We don't think it's time to be dipping into kind of PGMs, for instance, which we think could come under tremendous pain should Europe slow down and these tariffs remain, with a very negative impact on the auto sector, for instance. So we still think there's some pain ahead, and we're very selective at the moment and retaining quite a lot of cash in the portfolios.
Right. All right, thanks, Rafi. Maybe if I can step over to your side very quickly. Big concerns, I think, from everybody on SA bonds. I mean, I even get comments from clients saying, you know, won't the government default? If we look at where we're going, there's concerns about the GNU, how it's going to play out. Just playing devil's advocate. I mean, if there were to be a split in the GNU, what will the impact be on SA bond yields? Are we going to see those yields blowing out? Or is a lot of that bad news perhaps in the price already?
So it's a difficult question, and it is quite hard to actually work out how much is already in the price. But if you go back to that chart that I shared in my presentation, where you see the impact of the Nenegate, I think that currently the rand at last I looked was around 1970. I haven't seen this morning what it's done since, but you know, a lot of that is tariffs and that uncertainty. And I did some modeling just to try and work out, and I kind of was getting a range of between 1850 and 20 in the current environment. Should there be a collapse of the GNU, maybe you see the rand going through the 20 level. I think the SARB maybe even had a forecast and a risk of it getting to 21 to the dollar. And in that environment, you could even see bonds selling off by up to 2% in terms of where they were. So, you know, currently, if you're 10 years around 11%, maybe it goes to 12 and a half or thereabout. That risk is probably there, should there be a collapse of the GNU.
But I mean, we spoke about potential rate cuts, and there might be acceleration in 2025, maybe for all the wrong reasons again. But could that push us, I think, maybe a little bit closer to your base case scenario? You had the three cases there. base at roughly about 10.7, bull at 12.6, bear 4.9. So even if there's a wobble with the GNU and the political front, pressure on our bond yields, I'm sure more foreigners are going to leave our bond market as well. But if we see some rate cuts, could it bring us closer to that base case scenario?
So maybe just to elaborate a little bit on those scenarios, because you know, I was a bit short on time. But the thinking in terms of that base case was that there would be a significant amount of noise and uncertainty in the beginning of the year, which is really what we've experienced. And we thought maybe it would be noise as leverage to negotiate. There would be a bit of teething issues with the GNU passing the budget and finding consensus with political parties. But that as you went then into the second half of the year, that noise would begin dissipating, and you would be able to then see a path to renewed growth heading towards that 2% level that everyone was hoping for in the country. And within that environment, you almost anchor the longer end of your curve and potentially allow for 1 or 2 rate cuts during the course of the year. That gives you that 10.5%. The challenge and the risk now in terms of the way we've seen these tariffs implemented and the negative potential impact on growth means that over the longer term, if you're only going to get 1.5% growth this year and maybe next year, it means that the longer end of your curve is under a lot of pressure because there isn't sufficient growth within the economy to support a real rally in bond yields. And in that environment, we're quite concerned that, yes, it's true. Lower growth, softer inflation potentially does open the door for the SARB to cut rates. So what you'll end up happening almost is a steepening of your yield curve, where the shorter end comes down slightly as the SARB potentially cuts, and you're seeing now the FRAs and the market's pricing in an additional rate cut. So at the next meeting in May, maybe we get 1 cut potentially, although the SARB is rather hawkish and reluctant to cut in these types of environments. But let's say you get a cut early, and then maybe it allows and opens the door for 1 or 2 cuts later in the year. So you see the shorter end of your curve being anchored lower, but the longer end of your curve does remain under significant pressure. And I think one will have to be very strategic in terms of positioning along the yield curve in order to be able to extract returns and protect against capital losses at the same time.
I mean, for me to do that on client portfolio level is almost impossible. We see that happening in your flexible funds. I mean, you showed that graph as well, where your duration came down from 3.8 to, I think you mentioned, just below 3 now. And that's exactly that. You'll keep on managing the positioning on that yield curve to see which is the appropriate level for investors. Just in terms of foreign flows, Warren, you showed an interesting chart on we had some foreigners buying back into SA equity market. They all left again with that risk of trade. But roughly, what about SA bonds? I know last year we had a lot of greens on foreign net buyers of SA. Are we seeing the same on SA bonds? Are there foreign outflows?
So I mean, I actually haven't looked recently at the numbers, but without actually seeing it, and therefore don't want to comment directly. But one would expect that as long as there's policy uncertainty and a lack of investor confidence, we're not going to see foreigners flooding our market. Yes, there are opportunities because the real yields are super attractive. But in this kind of environment, generally investors are reluctant to commit capital to an emerging market that has an uncertain outlook.
We can only hope that politicians come to their senses, but I think that's a fading hope. Maybe just quickly on property, a question from the audience. I know this always comes up in income funds. We know there is allowance for property in income funds. You can include it if you want. Where are you on SA property? Is that something you will just like never include in income funds again, or are you considering it?
Well, look, I'm happy to leave this question for Warren in terms of his valuations, but within our flexible income fund and our high yield fund, we actually explicitly don't include property. It's just almost like a pure bond fund. Within our multi-asset funds, we feel that there is some quality within the sector and one has to be selective. But at least in terms of our income funds, it's something that we don't include as an asset class.
Yeah, I can.
And your views on property and flexible funds?
Yeah, I think the property sector very tied to the yield curve and what's happening with duration. So what we've seen year to date with the yields moving higher, and our view similar to roughly there's risk that bond yields move out further, especially as SA specific risk increases. And I mean, overnight you've seen this is over 24 hours US 10-year yields move 50 basis points, which is a significant move for what was seen as really a risk-free asset. So we're cautious on duration. When you step down into property, we look at the valuations relative to bonds. We still don't see enough of a premium to have significant exposure to property. But I will say the fundamentals seem to be slowly improving. So we're coming out of a very deep kind of period of contraction in SA property in terms of their fundamentals. Those are starting to look better. But on valuation, we don't see a great number of opportunities here.
It's always that relative argument. Question from the audience, Warren. With the oil price where it is and the ZAR under pressure, does Sasfin go to 200 or to 0?
Sasfin is now really a call option on oil. It's got significant debt. If oil falls to the 50s, Sasfin is in big trouble. Actually, ran an exercise yesterday on Sasfin. They probably cash flow slightly negative right now, and that starts to go quite negative as the oil price falls. And there's significant uncertainty on what chemical prices do in a disjointed world of tariffs. A business like Sasfin with over $6 billion of debt, there is a risk of a rights issue in this environment. So I think we don't own any Sasfin in the funds. We would not be a buyer at this point in time. We just think the risk is too high, and we quite focus on capital and not losing your capital as investors. So that's not the type of investment we would be owning right now in this environment. We're very low down on our picking order.
One last question. I mean, we know that things are under pressure. You made the comment, maybe not the time to, even at good valuations, to get back into the market, but or picking up more risk. Let me rather rephrase that. But anything in particular that excites you in the SA equity market, where you think, despite all the shenanigans going on, the trade wars, the GNU, politics, rand under pressure, are there still companies that can show decent growth in earnings for the remainder of this year?
Yeah, I think the most important aspect of the SA market now is the fact that you've seen the significant derating. So valuations are now on the cheap side again. And many of the companies we look at, and I'll give you an example of something like ShopRite. It's executing well. It should grow earnings this year. It shouldn't be significantly impacted by a trade war. And it's also come right back at share price. And that's one example. But then you look at the banking sector as well. Our banks were very well capitalized. They've been quite cautious on lending. They have high provisions, and they're trading. In some instances, we look at Nedbank and Absa at a 6 multiple, at a high single-digit dividend yield. So those are places we see relative areas of safety, which should still grow despite the environment. And then, of course, as you go out of the top 40, there's many names which are maybe less liquid, where there's certainly some interest, but I don't think we have enough time to go too much into those.
And I mean, from investor side, they always ask me, but why do you remain invested? And what I tell them at the moment, I mean, we could very well see a positive outcome on the GNU. We could very well see the trade wars de-escalating, because I think Trump is painting the US into a corner and estranging themselves from the rest of the world. But if all those things subside and there's positives around SA politics and stability comes back, I mean, then SA equity can potentially give you very good returns again, I think, for 2025. Would you support that?
Yeah, I mean, you saw on Tuesday, there was a tweet which was then actually was a false tweet, but on X, and it pointed to Trump putting a 90-day delay on the tariffs, and the US markets went from being down 4% to up 5%. So it just shows you how sensitive these markets are to the tariff news right now. And I mean, the big driver of the growth slowdown and potential recession in the world is the tariff imposition. If that is brought, if there's deals done, if China and Europe agree on deals, a lot of that risk will move out, and then the market should move higher. So it is a fine balancing act right now.
I quite like that picture of the orange swan.
Yeah.
So let's see which way it's going to go. Rafi and Warren, thank you so much for joining us this morning. It's always great to have you on these sessions, and thank you so much for your time. I think we covered a lot of ground. To our audience, you know how it works. If you want to get hold of either one of the fund managers, give us a shout, and we'll get you in touch with either Rafi or Warren. Gentlemen, thank you so much. Looking forward in having more discussions with you in the very near future. Thank you so much.
Thank you very much.
Thanks so much, Eugene. It's always a pleasure.
Good stuff. To our audience out there, just a quick reminder, next week, we've got boutiques on Wednesdays on the 16th with Granite and Reedway. But remember as well, we've got a session on Tuesday, a special session again on hedge funds, unpacking a little bit more with regards to hedge fund strategies, how they work, and a couple of guest presenters as well to continue with our series on hedge funds. Thank you all for joining. Thank you for your continued support. Looking forward to seeing you next week, Tuesday and Wednesday. Thank you, BCI team. See you soon.